Welcome to the Luxembourg Fundcast. Today we're diving deep into some pretty crucial shifts happening in the regulatory landscape here.
Absolutely. We're talking about changes affecting Luxembourg's fund industry, especially anything touching crypto assets.
Exactly. And for you listening, whether you're deep in the legal side, a director, maybe a COSEC, these changes are, well, they're significant.
They really are. There's a lot to unpack.
So our mission today is pretty straightforward. We want to unpack three key CSSF circulars. These all stem from recent ESMA and EBA guidelines on MiCAR the markets and crypto assets regulation.
And the goal is to really distill what this means, practically speaking, legal, regulatory, governance implications.
Making the complex simple, essentially, anchoring the key info for you.
Precisely. And these circulars, they came out quite close together, didn't they? All focused on putting MiCAR into practice here in Luxembourg.
That's right. We've got CSSF Circular 25885 first. That one's about the EBA guidelines on compliance templates for issuers of asset reference tokens, RTs, and e-money tokens, EMTs.
Then there's CSSF Circular 25886. This one tackles the ESMA guidelines on figuring out if a crypto asset is actually a financial instrument under MiCAR Article 2.5. A key
Very key distinction. And finally, CSSF Circular 25889, covering ESMA guidelines on procedures and policies for crypto asset transfer services.
So quite a bit to cover. Where should we start this deep dive?
Let's kick off with CSSF Circular 25885. This implements the EBA guidelines, that's EBAG L02416, focusing on those reporting templates for ART and EMT issuers. So who exactly needs to pay attention here?
Well, primarily it's the entities issuing these specific types of tokens, the RTs and EMTs, as defined in MiCAR. Think stablecoins, think digital versions of fiat currency.
Okay, and what's the main thrust? The big picture takeaway from these EBA guidelines being adopted by the CSSF?
Standardization. It's about ensuring consistent supervision across the whole EU. You see, MiCAR sets out rules, yes, including some reporting needs under Article 22.
But that data wasn't quite enough.
Apparently not. The EBA felt more detail was needed, especially on the financial health of these issuers. Things like their own funds, their capital buffers, and the liquidity of the assets backing the tokens.
The reserve assets.
Exactly. So these guidelines, now CSSF practice since April 30th, 2025, they introduce common templates. Everyone reports the same data points, making supervision more comparable and effective. It bridges those data gaps.
A level playing field for the supervisors then. And it helps the EBA too, right, with assessing significance.
Yes, precisely. It supports the EBA's job in figuring out if certain RTs or EMTs become systemically important under Articles 43 and 56, and generally helps with supervisory cooperation across borders, building that common supervisory culture.
Got it. So for the issuers listening, what specific information are we talking about? It sounds detailed.
Oh, it is. There are specific templates. For instance, S09.01 and S09.02 focus squarely on own funds requirements.
Okay, what does that cover?
Things like minimum required capital, the average value of the reserve assets they hold, their fixed overheads or running costs, and crucially, any additional own funds they might need based on risks identified, perhaps through stress testing.
So proving financial resilience,
Right.
does this apply to everyone issuing RTs and EMTs?
It applies to art issuers unless they're already credit institutions. For EMTs, it definitely applies to e-money institutions issuing significant EMTs. And potentially, the CSSF could require non-significant EMT issuers to report this too. So you need to check.
Okay, so own funds is one area. What else? You mentioned liquidity.
Right. Template S03.03 is the maturity ladder. This is quite interesting. It requires a detailed breakdown of the maturity profile of the assets in the reserve.
Meaning when those assets become cash or cash equivalent.
Exactly. It maps out the contractual maturity of assets plus expected inflows and outflows across different time buckets from overnight up to over 5 years.
And the purpose of that.
It helps supervisors spot potential mismatches. You know, situations where an issuer might face a wave of redemption requests, but their reserve assets are tied up for longer. It's key for assessing liquidity risk.
Makes sense. Ties into stress testing again, I suppose?
Yes, under Article 45.4, and it's also a factor in those significance criteria under Article 43, based on a related EU delegated regulation. And importantly, even some non-significant EMT issuers might need to use this template if they're required to hold a reserve under Article 582 or hold certain liquid assets.
So it's not just if you have the assets, but when you can access them relative to potential outflows. And there was more reporting for significance assessments.
Yes. 3 more templates, S10.01, S10.02, and S10.03. S10.01 is for general additional info.
And the others?
S10.02 gets specific about who holds significant stakes. We're talking 10% or more of capital or voting rights. Issuers need to report names, codes like LEI numbers, and whether it's a new acquisition or disposal of that holding.
Tracking ownership concentration.
Right. And S10.03 focuses on transaction data. Specifically, the average daily number and total value of transactions where the RT or EMT is used as a means of exchange.
Like for payments.
Exactly. And they're particularly interested in flows into and out of the EU where either the payer or the payee is within the union. Helps gauge cross-border usage and potential impact.
Okay, quite comprehensive. When does all this reporting start and how often?
Generally, it's quarterly reporting. Reference dates are the usual quarter ends: March 31st, June 30th, September 30th, December 31st.
And the submission deadlines?
Typically around 6 weeks later, May 12th, August 11th, November 11th, February 11th. But there's a nuance for the first reporting.
Okay.
For the own funds templates S09.01 and S09.02, there's actually no initial threshold. The very first report is due for the June 30th, 2025 reference date, with submission by September 1st, 2025.
So that's coming up relatively soon.
It is. For the maturity ladder, SS03.03 and the significance templates, S10 series, the reporting generally kicks in once the total value of tokens issued crosses EUR 100 million, or if the CSSF specifically asked for it earlier.
In the format, can issuers just send a spreadsheet?
No. It needs to be in specific data exchange formats that the CSSF will specify following the EBA's data point model and validation rules. So systems need to be set up for this.
Right, technical compliance is key. You mentioned crypto asset service providers. CSPs have a role here too.
They do. CSPs are vital conduits for some of this data, especially for EMTs linked to EU currencies and for the significance assessment data for all ARTs and EMTs.
What kind of data do CSPs need to provide to the issuers?
Information on the holders, both legal entities and individuals. For individuals, it involves using a special concat code, anonymized using SHA-256, to protect privacy but still allow for aggregation.
Okay, anonymized holder data.
And also transaction data related to the tokens being used as a means of exchange, the total values, so the issuers can calculate the required averages.
So CSPs have their own reporting deadlines.
Yes, they report quarterly to the issuers. Their reference dates match the issuers, but their submission deadlines are about 3 weeks earlier, say April 21st for a March 31st reference date, to give issuers time to compile everything.
Okay, that clarifies the first circular quite well increased standardized reporting for Art&T issuers involving CSPs too. Let's switch gears to CSSF Circular 25886. This one adopts the ESMA guidelines, ESMA 7518723302762032, on classifying crypto assets. Why is this classification so critical?
This is fundamental.
Right.
Because if a crypto asset is deemed a financial instrument under MiCAR Article 2.5, it falls completely outside MiCAR scope. Meaning it's subject to the existing, often quite different rules, primarily MiFID II, the Markets and Financial Instruments Directive, and potentially other financial regulations like the Prospectus Regulation or AIFMD.
That's a huge fork in the road, regulatory-wise. Affects licensing, conduct rules, investor protection, everything.
Absolutely everything. So getting this classification right is paramount.
And who needs to understand these ESMA guidelines? Just the issuers?
No, it's much broader. Competent authorities like the CSSF, obviously, but also issuers, offerers, CASPs, investors. Essentially, anyone touching crypto assets needs to be aware of how this classification works. These guidelines became effective May 18th, 2025.
So what's the core principle ESMA emphasizes?
Technology neutrality. That's the big one. The message is, don't get fixated on the DLT or blockchain aspect. Look at the substance. If it walks like a duck and quacks like a duck,
It's probably regulated like a duck, regardless of its feathers.
exactly. A tokenized share is still a share. A tokenized bond is still a bond. The underlying rights and economic function are key.
Okay, so how does ESMA suggest assessing if a crypto asset is a transferable security, like a share or bond? That's guideline 2, right?
Yes. The test is whether the crypto asset gives holders rights that are equivalent to traditional transferable securities defined in MiT 2.2. Think voting rights, rights to profits or dividends, claims on assets in liquidation.
Equivalent rights. What
Yeah.
else?
It also needs to belong to a class of fungible tokens, meaning they're interchangeable and grant the same rights. And, crucially, it needs to be transferable.
Transferable on capital markets.
Yes, negotiable on capital markets without unreasonable restrictions. ESMA acknowledges DLT might have specific operational requirements for transfer, but the principle is market negotiability. If it trades on a platform that looks and acts like a MiFID trading venue, that's a strong indicator.
Makes sense. What about crypto assets that might represent a stake in an investment fund? Guideline 4.
Right. This looks at whether the crypto asset is used to raise capital from multiple investors, pooling it to invest according to a defined policy for the investor's benefit.
Sounds like an alternative investment fund, an AIF.
Precisely. If it fits that description and isn't a UCSE, it's likely a unit or share of an AIF under AIFMD and thus outside MiCAR. The key is assessing if there's a genuine investment policy and the purpose isn't just general commercial activity.
Okay, how about derivatives? Crypto is often used in derivative contracts. Guideline 5.
ESMA addresses two scenarios here. First, if a crypto asset is just the underlying for a standard derivative contract, like a future or option, the derivative itself is generally handled under MiFID II rules for derivatives.
And the second scenario.
When the crypto asset itself functions as a derivative, this involves checking if its rights are tied to a future commitment or contingency, if its value derives from some underlying asset or benchmark, and if it uses settlement methods typical for MiFID II derivatives.
Like a crypto asset tracking an index with a future settlement.
Exactly. Or perpetual futures on crypto assets. ESMA specifically calls those out as derivatives falling under MiFID II.
Are there other categories mentioned, like money market instruments?
Yes. Guideline 6 confirms that if a crypto asset meets the MiFID II definition of a money market instrument, it's treated as such. And Guideline 7 does the same for emission allowances. If the crypto asset represents a recognized emission allowance under the EU emissions trading system and is tradable, it's a financial instrument under MiFID II.
Recognize being the key word there. Voluntary carbon credits might not count.
Likely not, unless they somehow gain official recognition. The link to the official EU scheme is crucial.
And finally, the one everyone asks about. Non-fungible tokens, NFTs. Guideline 8. What's the verdict?
The general rule is that unique non-fungible crypto assets, think digital art, collectibles, tokens representing a specific unique service or physical item, are outside MiCAR scope.
Okay, so generally excluded.
But, and this is a critical but, if an NFT, despite being unique technically, actually grants rights equivalent to a financial instrument.
Like a share in the artwork's future revenue, perhaps.
Potentially, yes. Or if it's part of a collection or fractionalization scheme that makes it function more like a security or an AIF unit. In those cases, MiFID II or other relevant financial regulation would apply, not MiCAR.
So substance over form again. Look past the NFT label at the actual rights and function.
Exactly. Assess the inherent attributes. This is especially relevant for hybrid tokens or fractionalized NFTs.
Very clear. That classification guidance is vital. Let's move to the third circular, CSSF Circular 25889. This implements ESMA's guidelines, ESMA 35-18713330276-2032, specifically on crypto asset transfer services. Who is the main audience here?
This is aimed squarely at crypto asset service providers, CASPs, who perform transfers of crypto assets on behalf of clients. Think exchanges executing withdrawals or wallet providers facilitating transfers between users. It's about standardizing the procedures and policies for that specific service as required by MiCAR Article 82. These guidelines took effect April 27, 2025.
Okay, so what are the core requirements these guidelines impose on CASPs offering transfer services? Guideline 1 seemed to cover general policies.
It does. It mandates that CSPs establish, implement, and maintain effective policies and procedures for these transfers. And importantly, before a client even signs up or agrees to the service, the CSP must provide a whole raft of information electronically. Their name and contact details, what info the client needs to provide to start a transfer, conditions for rejecting transfers, the process for determining when a transfer order is received, and any cutoff times for processing.
Fees, communication.
Yes, applicable charges, how they'll communicate, and any tech requirements, how often information will be provided, the language used, security breach notification procedures, the CASP's liability for bad transfers, and the client's right to terminate the agreement.
Wow, that's a lot of upfront information.
It is, and it has to be easily understandable, clear, and accessible electronically at any time. Clients must also be notified of changes in advance. ESMA also encourages CSPs to provide educational material about risks and rights.
So enhanced transparency from the get-go. What about information during and after an individual transfer? Guideline 2.
Right. Before executing any transfer, the CSP must give a brief, clear warning about the irreversibility of crypto transfers or the probabilistic nature of finality on some blockchains.
That's important. The no backsies warning.
Precisely. And they also need to show the amount and a breakdown of charges separating network fees like gas from the CASP's own fees. Crucially, initiation should only happen after complying with the Transfer of Funds Regulation, 20FR.
And after the transfer goes through.
The CASP must provide details: originator and beneficiary names and DLT addresses or account numbers, a transfer reference, the amount and type of crypto asset, the value date, and again, a full breakdown of all charges paid.
How often does that post-transfer info need to be given?
Electronically and free of charge if provided no more frequently than monthly. If a transfer gets rejected, returned, or suspended, the CSP has to tell the client why, how to potentially fix it, and details about any charges incurred and possible refunds.
Okay. What else do the guidelines cover? Execution times, Guideline 3.
Yes. CSPs need policies on cutoff times for same-day processing, maximum execution times for different crypto assets, and importantly, reasonable estimates of the time or block confirmations needed for practical irreversibility on each specific DLT network they support.
So clients have a clearer idea of how long things should take.
Exactly. Guideline 4 requires risk-based policies for deciding whether to execute, reject, return, or suspend transfers. This ties strongly into AML-CFT obligations under TOFAIR and related EBA guidelines.
Makes sense. And finally, liability, Guideline 5.
CASPs must have clear policies defining their liability to clients if a transfer is unauthorized, or if it's initiated or executed incorrectly due to the CASP's fault, defining who is responsible when things go wrong.
Okay, so bringing this all together for you, our listener, these three circulars are really putting meat on the bones of MiCAR here in Luxembourg.
Definitely. For ART and EMT issuers, Circular 25885 means gearing up for detailed, standardized reporting. You need robust systems for tracking own funds, reserve asset maturity, and gathering data for significance tests, often relying on your CASP partners.
And for everyone in the space, Circular 25886 and those ESMA classification guidelines are fundamental. Is your token under MiCAR? Or is it actually a method financial instrument? Getting that right dictates your entire regulatory path. The guidance on NFTs and hybrids is helpful, but requires careful, substance-based analysis.
And for CSPs providing transfer services, Circular 25889 raises the bar significantly on client communication, transparency around fees and risks like irreversibility, clear execution timelines, and defined liability. Robust policies aren't just good practice anymore, they're a regulatory must.
These developments aren't just about ticking compliance boxes, are they? They're actively shaping the future structure and operation of a crypto asset market in Luxembourg and across the EU.
Absolutely. Understanding these guidelines helps you navigate, manage risk, and align your operations with what regulators now expect.
It certainly provides a clearer framework, though navigating it will require attention to detail.
And it perhaps leaves us with a thought for you to ponder. As these regulations bed in, demanding more transparency and structure, how will this affect the balance between fostering innovation in the crypto space and ensuring robust investor protection and market integrity here in Luxembourg? It's a delicate balance regulators are trying to strike.
An important question indeed. This has been a deep dive on the Luxembourg Fundcast. We hope this breakdown has provided you with valuable insights into these key CSSF circulars.
Remember, always consult the full official texts for the complete details and seek specific legal advice for your own situation.
Thanks for joining us. Join us next time for another in-depth exploration on the Luxembourg Fundcast.